Hi there, I'm Patti Ogilvie and I'm a senior enrollment counselor with the Student Loan Help Group.
And I'm Sam Pettingill. I'm also a senior enrollment counselor with the Student Loan Help Group.
So today we're going to go over some common myths that we hear out there about student loans. And so we're just going to go through a couple that we hear and give you our take on them. And then we'll go from there.
Sounds good. So one of excuse me, one of the myths that we hear all the time is that a lower interest rate is always better on your student loans. Is that something that's true, Patty, or is that a myth?
So it really depends on each individual person's situation. If somebody's working towards public service loan forgiveness, for example, I don't want to say the interest rate is irrelevant, but it kind of is, because whatever's left when you hit payment 120, that's what's going to be forgiven, no matter what that balance is, as long as everything's been done correctly. So that's principal, interest, and it's tax-free. But if somebody were on a different type of repayment, then just like with a mortgage or your car payment, the lower the interest rate, if you're on a regular standard repayment, for example, then the lower your monthly payment. So it is relevant, just depending on each individual person's situation. And so Sam, we always hear, if you can't afford your loan payments on your student loans, you should just stop paying until you're financially able. Is that true?
Yeah, that's something that people say a lot. And it's something, unfortunately, that sometimes the servicers have kind of created a little bit of a misconception around too. We hear that all the time when we're speaking with people, that they say, I called my servicer and said I couldn't pay. And my servicer said, why don't you go into forbearance instead? Forbearance really has no downside for the servicer, because they know you're not going to be able to get out of your student loans. You're going to have to pay them eventually. So forbearance is just time for that interest to build up. Taking time off because you're not able to make your loan payments is not necessarily the best option when there are other options available for you, like income-driven repayment. If you're struggling financially, you should look at income-driven repayment first before you say, I should just go into forbearance, because really forbearance is not benefiting you. If you're going towards a forgiveness program, time and voluntary forbearance is not going to count towards, say, public service loan forgiveness or IDRF. If you're not working toward a forgiveness program and you're in a scenario where you're just trying to pay your loans off and save money, the longer you sit in forbearance, the longer you're going to eventually be in repayment, because your interest is going to keep going up. Right. So stop paying your loans is really your last resort. Obviously, if you do have to stop paying for some reason, you want to do that with a forbearance. You don't want to damage your credit by just not paying, but that's not your best option compared to, say, an income-driven repayment that is designed to be affordable for you.
Right.
Now, there's something else we hear a lot, kind of in the same related vein. People talk about private student loans versus federal loans, and they say private and federal student loans are basically the same. Now, is that true, Patty, or is that a myth?
That is a myth. Private loans are through private institutions, whereas federal student loans, they're through the Department of Education. And if there's any federal forgiveness programs out there, you have to have a federal loan in order to qualify for that. Private loans do not qualify for that. Oftentimes people will refinance their federal student loans, and what they are not aware of is that by doing that, now they've taken them out of federal status and now they're private. So you, at all costs, don't want to refinance your federal student loans unless you absolutely have to. And anytime you can get a federal loan instead of a private loan, then that's also going to be your best option as well. You have many more options. Now, we were just talking about not paying your loan, Sam. So let's go back to that for a minute. Now, student loans, people think that that does not impact your credit score. True or false?
Absolutely false. And I can vouch for that. I have my own student loans. I've been in repayment now for about 10 years. I bought a home recently. So, I mean, I've seen how student loans do impact your credit score. There's a few different ways that they can affect you. For one thing, obviously, if you don't make payments on your loans, that's going to be reported to the credit bureaus as a late payment or a missed payment. That will affect your credit. If you miss 9 or more consecutive payments, you may go into default. That, of course, affects your credit, because that will sit on your credit for 7 years, just like a bankruptcy will. The other things that can impact your credit score related to student loans, obviously, if you continue having a positive repayment history, that's going to help you. One thing I've noticed on my own loans is that the CARES Act forbearance that we're in right now that's being reported to the credit bureaus as on-time payments. Even though we have no obligation to be in repayment right now, that is being reported as on-time payments. That helps your credit, of course.
That's great.
Yeah, it really is. The other thing people don't always realize is that one of the factors that goes into your credit score is account age, average account age. For a lot of people, your student loans may be your oldest account. So they're actually helping you build credit too, which is, I mean, for me, starting out, that was very helpful because that was the only credit account that I had, and continuing to make payments on that helped me build credit. So it definitely does have an impact, for good or for bad, depending on how you deal with your loans. Now, in the whole idea of not making payments, one of the things we hear sometimes, there are times where you don't have to make payments. Like, for example, if you're in school, or you're in a grace period because you've just left school, or if you're in forbearance. A lot of people think it's not worth making payments on your student loans during those times. Is that true, or is that a myth too?
Again, it's going to be dependent on each individual person's situation. If somebody is in their grace period or in school, but they have other loans, it oftentimes is better to go into repayment on those older loans, especially if it's on an income-driven repayment and your payment is going to be like $5 or $10 a month, for example. That's something that you can easily afford, and then you'll be racking up those qualifying payments toward the forgiveness program. So again, each individual person's situation is different. When somebody's in school status on a particular loan, they cannot repay that one, but the loans that they put on deferment, that's something that they do have the option to do if it's going to benefit them. And so, Sam, we also hear that you can't save and pay off your student loans at the same time. What do you think about that?
Well, I would say that's not necessarily true. I've seen plenty of instances where people are able to do both. For one thing, if you're working toward a federal forgiveness program, something like public service loan forgiveness, your payments are based on your income and your household size. So whereas your standard payment might have been something like $500 a month, an income-driven payment for you, depending on your income and your household size, might work out to be significantly less. So that difference is something that now you could work towards saving instead of, having to pay that toward your loans. And because it's all going to be forgiven at the end anyway, it's not going to matter in terms of, yes, you're not making the full amount of the standard payment, but that difference is something you could save instead and still see it forgiven at the end. So that would be one instance where you could easily save and pay off your loans at the same time. Really, for anyone who's in an income-driven payment plan, because you would have a significantly lower payment, that's going to give you a little bit of room that you would be able to use that difference to put into your savings. So it's absolutely achievable.
Very good.
Now, one of the other questions we hear a lot, we talked a moment ago about private and federal student loans. There's some misconceptions around consolidating student loans. People often say consolidating a student loan is the same as refinancing one. Is that true?
No, that absolutely is not true. Take, for example, your house. Mortgage on your house and you refinance, you're getting brand new terms and brand new repayment amount and interest and so forth. When you consolidate your loans, you're taking the same loans, and the Department of Education is now issuing you a direct consolidation, subsidized and unsubsidized. So you literally could have 10 loans, and by consolidating them, now you're making them into 2 loans, which is, we're talking about credit. That can be a positive impact on your credit by going from 10 loans to 2 loans. So also the terms will remain the same when you consolidate. It's not like you have to requalify, get your credit pulled, getting a new interest rate. So absolutely, they are not one and the same.
That's true. And often refinancing ends up making your student loans private student loans. That would be something that you'd have a company coming in and kind of taking them over, whereas consolidation keeps them federal too.
That's exactly right. What we were talking about earlier, you don't want to get a private loan because now your options are very limited. So yeah, absolutely not the same thing. Now, another myth that we hear is that if somebody wants to change their repayment plan, is that they have to pay to do that. True or false?
Not true at all. That is definitely false. So you don't have to pay to change your repayment plan. It's definitely something where you want to make an informed decision before you change your repayment plan, because depending on what your strategy is to deal with your loans, there might be consequences to that. Like, for example, if you're going for income-driven repayment forgiveness, the different payment plans have different amounts of time that they need to be into repayment before they can be forgiven. So that's something to keep in mind. Or for example, you might need to be in a different income-driven repayment plan based on your tax filing status. Those are things to consider before you change your repayment plan. Just as
Right.
you would consider, like, for example, if you're not even changing to an income-driven payment, if you're changing between the standard and something like graduated or extended graduated, you want to know what the interest repercussions of that will be. Because
Right.
a lot of those payment plans where you go, oh, this is a lot lower to start with, it's a lot lower for right now, it's more comfortable for me, you're going to be interest loaded and paying a ton of interest later on.
Right.
So,
Because what a
those
lot of
are all
people,
things to think about, but you won't have to pay to change your payment plan.
right, right. Because a lot of people think that the lower the payment, the better it is for them. But what they don't realize is that on some of those standard repayment options, it's amortized over 25 or 30 years, which is just like paying a mortgage. So yeah, definitely you want to be informed when you're making that choice for sure.
Yeah. And for a lot of people going into something like extended graduated or even just extended fixed, I've seen that the interest you pay back ends up being as high as your balance was to begin with, or even higher.
Exactly.
So,
Exactly.
you don't want to double what you're paying back. You want to make sure you're not making that kind of decision for yourself.
Exactly.
Now, one other thing I hear a lot, all the time, actually, from people who are in public service, the program Public Service Loan Forgiveness has gotten a lot of attention recently. And I've talked to many people who have said, well, public service loan forgiveness is automatic if you work in public service. It just happens. Is that true or false?
That is completely false. There are so many hoops that you have to jump through when you're working towards public service, and it's ongoing for the full 10 years. And if you do not keep up with the requirements every single year and get, for example, your income, your household size, and your employment recertified, when you hit payment 120, they will deny you. So there is a lot that does go into obtaining that public service loan forgiveness, and it's not going to be automatic at all, regardless of what your servicer may tell you, because we've heard different things that servicers tell people. So that is absolutely not true.
Yeah. And especially right now with the limited waiver being in effect and coming to an end in October, that's a really dangerous assumption to make, because if you don't get all of the paperwork in before that October 31st deadline, you're really putting yourself at a disadvantage. You're not going to receive the benefits from that either.
Absolutely. And the waiver is really important because, like you said, that's going to expire in October. And we've seen many, many people that we've worked with that because of that waiver have actually hit 120 payments from their past. If they waited till like October or November to deal with it, they would be starting over at payment number 1. So really important to always know what your options are.
Definitely.
So I think that's it, Sam. I think next time we're going to talk about programs and resources that people may not know that are out there and that are there for them to check out.
Great. Wonderful. So, until next time, I guess.
Yeah. Take care, everyone.
Have a great day.